If you're like most traders out there, you're struggling to find a strategy that delivers consistent results. The good news? This trading strategy, built around trading order blocks, offers a solution that's perfect for both price action enthusiasts and traders who rely on algorithmic tools. It's designed to pinpoint precise entries and exits, helping you trade with confidence and consistency. That said, I've tested it 100 times on Tesla to ensure its reliability. Stick around until the end of the video, where I'll share a full breakdown of my trading results. To get started with this strategy, open TradingView and begin with a clean chart. This strategy uses just two indicators. First, click on the Indicators tab, search for LuxAlgo's price action concepts, and add it to your chart. Keep in mind that this is a premium indicator, but with my link, you can save up to 50% on the annual plan. Plus, LuxAlgo offers a 30-day refund policy, so you can test their indicators completely risk-free. Next, search for and add the Kalman Trend Levels indicator by Big Beluga. Let's now adjust the indicator settings to optimize them for our strategy, so let's double-click the Price Action Concepts indicator. First, within the Market Structure section, we want to set the internal market structure to None. Next, in the Volumetric Order Blocks section, we want to set the length for the order blocks to 10. Now click OK. For the Kalman Trend Level settings, I kept the default length for both lines. I changed the colors to blue and purple, disabled the candle color option, and in the style section, I turned off titles, boxes, and labels. Before diving into the exact trading rules, let's first understand how the key components of this strategy work and how we're going to use them. And let's first understand LuxAlgo's order blocks. These blocks show areas on the chart where big players, like institutions or professional traders, are placing their orders. Think of them as hotspots where the market often makes big moves. Order blocks are divided into two types, bullish order blocks and bearish order blocks. A bullish order block usually appears near a swing low. On the other hand, bearish order blocks are near swing highs. What makes these order blocks special is the extra data they provide. You'll see green and red bars inside them. Green bars show bullish activity, while red bars show bearish activity. This helps you understand if the market is more likely to respect or break through an order block. Plus, you'll see metrics showing how significant an order block is based on its volume. Bigger volume means it's more likely to impact the market. Now, for our strategy, we'll use two entry conditions. The first entry condition is price action exiting an order block. This tells us the market might be ready to make a move. The second condition is price action re-entering and mitigating this order block. And now that we understand the volumetric order blocks, let's take a look at the Kalman Trend Levels indicator. This tool smooths out price action to help traders identify trends more accurately. If you're an advanced LuxAlgo trader like me, you can use it specifically for setting precise stop-loss levels, and that's my main focus in this strategy. However, if you're new to trading, I recommend using this indicator as an additional layer of confirmation. Only take a buy trade if the indicator shows bullish signals, and enter a sell trade only if it signals bearish trends. Now for the fun part, let's dive into the trading rules and see how this strategy can be used profitably. I'll break it down step by step so you can follow along easily. So let's first start with the conditions for a valid buy trade. First, we need to see a bearish order block located above the current price action, and the price must have completely exited this order block, just like we can see here on the chart. Second, wait for the price to increase and enter into the order block. At this candlestick, we can see the candle entered and closed within the order block, but we need to check for two things before entering a trade. The first thing we need to check is the buying and selling volume within this order block. When the bullish volume is higher than the bearish volume, it's a strong indication of a potential shift in market sentiment. This happens because higher buying pressure suggests buyers are actively stepping in, which could mean sellers are losing momentum or getting exhausted. As a result, the bearish resistance might fail, leading to an upward price movement. This gives us more confidence that the price is likely to break higher. Finally, we need to wait for a candlestick to close above this order block and for the order block to be mitigated, meaning it disappears from the chart. If all conditions are met, enter a buy trade at the close of the candlestick. For the stop loss, use either the Kalman Trend Levels indicator, an order block, or the most recent swing low. For taking profit, we'll aim for two targets. For the first target, we'll target a 1 to 1.5 risk to reward ratio. Once the price action hits our first target, we'll close half of our position. Next, we'll move the stop loss slightly above our entry to protect our capital. Finally, for the remaining position, we'll aim for a 1 to 3 risk to reward ratio. Let's walk through another buy trade example. The first step is to identify a bearish order block positioned above the current price action. The price must have fully exited this order block, as you can clearly see on the chart. Next, we wait for the price to rise and re-enter the order block. At this point, we see the candle entering and closing within the block. However, there are two additional conditions to confirm before placing a trade. The first condition is that the buying volume within the order block must outweigh the selling volume, signaling strong interest from buyers. The final step is to wait for a candle to close above the order block, at which point the order block will disappear from the chart. Once all conditions are satisfied, it's time to enter a buy trade at the close of the candle. For the stop loss, you can use the Kalman lines, an order block, or the most recent swing low. For taking profit, we'll use again two levels. The first target is set at a 1 to 1.5 risk to reward ratio. When the price reaches this level, we'll close half of the position. Then, the stop loss will be moved slightly above the entry price to safeguard our capital. Finally, for the remaining position, the goal is to achieve a 1 to 3 risk to reward ratio. And the exact opposite is true for sell trades. First, we need to see a bullish order block located below the current price action, and the price must have completely exited this order block, just like we can see here on the chart. Second, wait for the price to decrease and enter into the order block. At this candlestick, we can see the candle entered and closed within the order block, but we need to check for two things before entering a trade. The first thing we need to check is the buying and selling volume within this order block. When the bearish volume is higher than the bullish volume, it's a strong indication of a potential shift in market sentiment. This happens because higher selling pressure suggests sellers are actively stepping in, which could mean buyers are losing momentum or getting exhausted. As a result, the bullish support might fail, leading to a downward price movement. This gives us more confidence that the price is likely to decrease further. Finally, we need to wait for a candlestick to close below this order block and for the order block to be mitigated, meaning it disappears from the chart. If all conditions are met, enter a sell trade at the close of the candlestick. For the stop loss, use either the Kalman trend levels indicator, an order block, or the most recent swing high. And for taking profit, we'll aim for two targets. For the first target, we'll target a 1 to 1.5 risk to reward ratio. Once the price action hits our first target, we'll close half of our position. Next, we'll move the stop loss slightly below our entry to protect our capital. Finally, for the remaining position, we'll aim for a 1 to 3 risk to reward ratio. Let's take a look at another sell trade example. First, we need to identify a bullish order block positioned below the current price action. In this case, we can clearly see that the first condition is met. Additionally, the selling volume within the order block is much higher than the buying volume, which indicates strong selling pressure and a potential failure of the bullish support. In this example, the price directly slides through the order block without hesitation, which gives us the signal to take this trade. Once we're ready to enter the sell trade, we do so at the close of the candlestick. For taking profit, we again aim for two levels. The first target is set at a 1 to 1.5 risk to reward ratio. Once the price reaches this level, we'll close half of the position. Then, we'll move the stop loss slightly below the entry price to protect our capital. Finally, for the remaining position, the target is a 1 to 3 risk to reward ratio. Now that we've gone over the trade setups, it's time to deliver the backtesting results, just as I promised at the beginning of the video. I've tested this strategy 100 times manually on the Tesla chart, using the hourly time frame. I started with a $1,000 account balance. I used 10% of my account per trade, adjusting as my balance changes with each win or loss. For example, if I profit $100 on a trade, my new balance becomes $1,100, and I use 10% of this updated balance for the next trade. If you want to learn my best strategies for trading crypto, forex, and stocks, check out this video right here.